According to this week's release from the Commerce Department, the U.S. economy has been growing at its fastest pace in almost 40 years, and we also have corporate profits being the highest that they've been in 70 years. The stock market, although which is gyrating wildly of late, is still scoring what we call record gains. So why do most Americans remain gloomy about this economy? Mainly because their real inflation-adjusted wages continue to go fucking nowhere. Now, steeply rising profits, economic growth, and stock market highs, and which are coupled with the near stagnant wages, has been the story of the American economy for decades, and most economic gains have gone to the fucking top. So why not share the fucking profits? Profit sharing was tried with great success in the early fucking decades of the 20th century, but it is now all but forgotten. In 1916, we had Sears, Roebuck and Company, which was then one of America's largest corporations with more than 30,000 employees, announced that it would begin to share profits with all of its employees, giving workers shares of stock and thereby making them part-time owners. The ideal caught on to this. The other companies that joined the profit-sharing bandwagon included Procter & Gamble, Pillsbury, Kodak, and U.S. Steel. Now, the Bureau of Labor Statistics suggested profit sharing as a means of reducing frequent and often violent disputes between employers and workers. Profit sharing gave workers an incentive to be more productive, since the success of the company meant higher profits would be shared, and it also reduced the need for layoffs during recession time because payroll costs dropped as profits did. In the 1950s, Sears workers had accumulated enough stock that they owned a quarter of the company. By 1968, the typical Sears salesperson could retire with a nest egg, which is well worth over $1 million in today's money. The downside of this was that when the profits went down, workers' paychecks would shrink, and if a company went bankrupt, workers would lose all the investment that they had in the company. The best profit-sharing plans took the form of cash bonuses that employers and employees could invest however they wish, on top of any predictable wages. Now, profit sharing with regular employees all but disappeared in the large U.S. corporations. Ever since the early 1980s, when corporate raiders, now private equity managers, began demanding higher returns, the corporations stopped granting employees shares of stock, presumably because they didn't want to dilute the share prices, and Sears phased out its profit-sharing plan back in the 1970s. But yet, just as profit-sharing with regular employees disappeared, the profit-sharing with top executives took off, as well as the big Wall Street banks, hedge funds, private equity funds, and the high-tech companies that began doling out the huge wads of stock and stock options to their MVPs. And the result of this, share prices and chief executive pay composed increasingly of shares of stock and options to buy the stock. And they have gone into the stratosphere, while the wages of the typical worker have barely risen. Researchers have found out that before the 1980s, almost all the increases in share prices on the U.S. stock market could be all accounted for by what we call overall economic growth. But since then, a large portion of the increases have come out of what used to go into wages. Jeff Bezos, who now owns around 10% of Amazon shares, is worth $170.4 billion. Other top Amazon executives hold hundreds of millions of dollars of shares, but most of Amazon's employees, such as warehouse workers, haven't shared in the bounty. Amazon used to give out stock to hundreds of thousands of its employees, but in 2018 it stopped that practice and instead raised its minimum wage hourly to $15 an hour. The wage raise got headlines and was a good PR, but Amazon is still touting it. But the decision to end stock awards was more significant. It hurt employees far more than the increased minimum helped them. If Amazon's 1.2 million employees together owned the same portion of Amazon stock as Sears did, as the Sears workers did back in the 1950s, a quarter of the company each Amazon worker would own now. Shares worth an average of more than 350,000. America's trend toward higher profits, higher share prices, mounting executive pay, but near stagnant wages is unsustainable, economically and politically. Profit sharing is one answer, but how can it be encouraged? Reduce corporate taxes on fucking companies that share profits with all their fucking workers and increase taxes on those that fucking do not. Sharing profits with all U.S. workers is a logical and necessary step to making the system work for the many and not for the few. So if you like the video, give the video a like and subscribe to my channel, RBW King, and also hit the notification bell so that you'll be notified when a new video comes out, and thanks for listening.